The second time is there. Yeah. Good evening, everyone. Today we've got thin attendance, but every time what happens is after 6:35, 6:40, the attendance starts improving. So today our speaker is Neil Parekh, and in the month of January, Neil had given a presentation on the bubbles of the gold as well as the real estate. And that time the prediction was that you cannot be invested into all these asset classes, especially when the prices are just going up. It was sort of a warning sign that they are in a bubble zone. And today Neil is going to give a presentation on explaining the different types of bubbles which take place in the history of the world, as well as trying to explain what are the behavioral tendencies come when a bubble is formed in the market. Over to you, Neil.
Okay, so today we'll be talking, like he said, we'll be talking about bubbles. We all actually know what bubbles are because we all have experienced them. All of us have experienced at least 2 bubbles in our lifetime. The most recent one being the global financial crisis, where we had the real estate bubble, the infrastructure bubble in India, and before that we had the IT boom in 2000. So I'm sure we all have experienced at least 2 bubbles. The thing about bubbles is that we hope that they don't happen, because we want like stable asset prices going on, but bubbles will keep happening in our lifetime and will keep happening throughout life. Basically is because human beings don't actually learn from bubbles. So today we will understand the psychology prevalent during a bubble phase in order to not get into a bubble trap. Okay. So it's very hard to know when there's a bubble. Okay, it's only when the bubble has reached a very high level that when people can start thinking, oh, we were in a bubble, or there's going to be a bubble. So in a nutshell, a bubble is when we look back and say, what the hell were we thinking? What the hell were we thinking? Paying for such exorbitant prices for assets which shouldn't have been anything like they were going at. So recently, like I said, if you think back at the IT boom in 2000, we could see, if you just go back and we'll see the price of Infosys and companies like Silverline, which don't even exist today. People paid exorbitant amounts for them. Looking back today, we are like, why the hell did we pay that much for them? More recently is when we had the real estate boom. Any and every real estate company would go up, and they would be quoted at really high prices. Their valuations would be 3-digit valuations of P's, like more than 100 P's some of these companies were, and people were still lapping them and still buying them. And today when we look back, we're like, why did we do that? And that's the thing about human behavior. It's going to keep happening, because during this euphoric times that I call it, there's a lot of irrationality in the market, and this irrationality is by rational people. So we need to be careful about abnormal growth. Whenever we look back and we see a graph which is very steep, is something to be really careful about, because in the end the law of the farm works. What we sow today will have to go through a seasons before we can reap it. Even with it's a natural law. It's a natural law, and it has to be followed everywhere. It's just that when we see such abnormal growth, everyone gets euphoric and everyone gets irrational, and you get into the bubble phase, and that could be dangerous if you don't get it at the right moment. So how is the bubble formed? Okay, now the bubbles, when they are the bubbles or these manias that we call them, they're not castles entirely built on air. They have some foundations. The foundations such as during the IT boom, the information technology is going to change our lives. Sure enough, it has changed our lives. But the problem is when this optimism is taken to a different level, that these problems start having, that we start having these problems. And the bubble is formed when there are many greedy investors. That's the whole hypothesis. When there is a good foundation, there is something happening. India is growing, India is shining. Yes, we will need infrastructure. Yes, we will need real estate. We will need power. All that is all good. But when we take it to a different level, when we just extrapolate that into the future with unrealistic projections, that is when all this starts, because then that's when the greed comes in. So we need many greedy investors who are willing to allow someone to exploit their greed. Now we are at the height of bubbles, we could see, for example, management taking advantage, like company management taking advantage by coming out with any and every IPO. You know, they could be like any silly company would just come with an IPO. They are going to take advantage of your greed. Bankers will give you loan for anything. Will give you loans for anything. Your brokers will make you trade and make you get into derivative segments, because to make a quick buck, because they are going to take advantage of your greed. Now this greedy crowd keeps on increasing. So it starts small and it starts increasing. A lot of people don't want to miss the bus. They want to get in. So the more crowd comes in. Other greedy investors join the pattern due to envy. This envy is a big sin in this market, because you cannot be envious of someone. Okay, somebody's made money, but the thing is that you don't want to be left out of the bus. So you will enter at all wrong times. You know, when you're not supposed to enter, that's when you will enter, because that's when the envy will be the highest. So when this envy comes, so the more greedy investors join, more greedy investors join, so it becomes into a snowballing effect. Now this snowballing effect will lead to a creation of an illusion in the form of a bubble. And when that happens, when a lot of people are participating in this bubble, then it's ripe to be pricked, and it will be pricked at some point. The two main causes of this mass hysteria are, one is excessive optimism. The people in good times will think they will continue forever. There's not going to be any bad times. It's just going to keep on going on and all. So we are not concerned. They get more adventurous, take more risks, and they feel confident if they made a couple of good bets and they've gone up. They feel that, okay, you know, this is going to go on forever. They feel even more optimistic about it. The problem with company management at this point, when they see this excessive optimism, this is the time when they will start coming in and trying to take advantage of you by coming out with IPOs, by having lofty plans for the future, or taking huge amounts of loans, you know, because they think good times are going to continue. So when we see this excessive optimism, is the first sign that, okay, you know, we might be getting into a bubble kind of a scenario. This excessive optimism leads to overconfidence. Overconfidence, own ability or knowledge, you know. During these times, media plays a very big role. You know, media will keep showing things that are the current fads, the current whatever is important. If it's real estate, they'll just be flashing real estate, news about real estate stocks for 24 hours of the day. And when the problem is when investors are confusing this over information as knowledge. Because if they might have made money in one or two stocks, they will think that, oh, you know, I am a master. Like, so they get very overconfident, and they think that this this knowledge, they take this knowledge as information, but in fact it's not any knowledge, because it's very different having information about a company stock compared to knowledge about the business that the company is in. They're two very different things, which sometimes can be taken as one, which is extremely wrong. So this excessive optimism and overconfidence, when this base is there, so first we have a foundation. We have a foundation that, okay, something good is there, but then when it's taken to a next level, that's when optimism and overconfidence comes into play. Now this leads to greed. Greed, because it's a herd mentality. Everyone wants to rush into it. They keep hearing about all these things on TV from their friends. Everyone is talking about it. They feel like, no man, we don't want to miss the bus, so we are going to get in. So it's the herd mentality that gets them in. Irrational behavior by rational people, you know. This is the time when, you know, when we say smart people make big money mistakes, this is exactly the time when that happens, because they're like, okay, you know what, I'll get in, and I'm smarter than everyone else. I'll get in, I'll get out before them, before anything happens. And we've seen this a lot. So a lot of irrational behavior by rational people. Again, like I said, the management, greedy management want to exploit this greed. So this greed and irrationality. So they come with IPOs. They take huge loans from banks to come up with expansion plans for the future, which are on projections which are totally baseless and irrational, because it's on current time, which is not going to last forever. Bankers can sell high interest loans to finance this greed. You know, at this time, people are optimistic, overconfident. They want cars, they want another house, they want a second home, they want a lot of things. And bankers, they are more than happy to give you that. They want to exploit your greed at this point. So when you see home loans and car loans and all these loans getting a lot of attention, and that's more in the news, and you're getting cheap loans and everything, that's another sign to just be wary that bubble scenario might be there. Brokers encourage derivative trading at this time because people are again overconfident. They want to, and they will cut your, they will say that we will give you wafer thin brokerages, but you keep trading, you start day trading. They will make more money out of that than before that, you know. So that's the thing. So even everyone is there to take advantage of the greed, of your greed. Now when this greed is coming along and it's in a very high volume, this leads to envy. Envy because the people, this is the time when the bubble is actually quite ripe, you know. This is the time when people feel, oh shit, I have missed out, so I want to get in, you know, whatever it is, whatever the price it is, I want to get in. This is the time when most of the people get in. This is the time when most of the people get in. A lot of retail investors get in at this point, feeling the feeling that I have missed the bus, there's something wrong. And the problem is the media keeps showing TV shows 24 hours. I have made so much money. I have this success story, that success story. So many people's success stories. Brokers come on air. They talk about what they've done and how much they've made money. So the envy feeling is even more then. Envy is even more, and that's when they want to come in. This will lead to a full snowballing effect. And the problem is that people will only talk about their fortunes they've made. They are not going to talk about the losses. So people during a bull time will only talk about how much money they've made, what they've done. They got in at the lowest stage, now they sold at the highest stage. But no one will talk about how much money they've lost. So this even fuels the greed, because you're only hearing good news, but you don't know that what that person, what leverage he's taken, or what other losses he's made somewhere else. So all this together just makes the snowball effect even greater, and now the bubble is ripe to be pricked. So those were the few important human anomalies during a bubble phase. And what are the other behavioral anomalies during the bubble? Availability heuristic. Here is the media. The media plays probably one of the biggest parts in making a bubble, because they are the ones who create these fads and fancies of the market. You know, they have, if real estate is in the news, or power is in the news, or IT is in the news, 24/7 they will have their TV channels, they'll have their reporters only talking about this. They'll get brokers, they'll get government officials, they'll get people to just talk about it, because people only want to hear about this. So the availability heuristic is really high. And the problem again with advertisements and everything, like I was telling you all last time, 2 months back, I spoke about gold and what the availability heuristic is there. I was telling you all at that point, there was a cricket series, I think India-England series I was watching last year, and every second ad used to be a gold finance ad, or Muthoot Finance or something like that. You know, I'm sure you all have seen it. That so the advertisement, if it's kept on bombarded at you, you're going to keep thinking, okay, this is good, I need to get into it, everyone is getting into it, why should I not get into it? So that plays a big role. Recency effect is again, it's something has to do with availability heuristics also. It's about what's recent in your head, what you keep hearing. You're in the train, you keep hearing people talk about a particular thing. If it's gold, people are just talking about gold. If it's about real estate, you're just talking about real estate. So it's just recent in your head, whatever is recent in your head, you're gonna like want to be a part of it, because you don't that feeling of missing the bus should not be there. And this is where the greater fool theory works, because a lot of people think that, you know what, I'll get into it, and I'll sell fast before somebody else can do it. I will sell it to that other fool, who's a bigger fool than me. But sometimes that doesn't really happen, and when the bubble pricks, everyone gets hurt. Representative bias. This is representative bias is pretty much during, say, like when we had, for example, IT boom, Dotcom bubble. Every company would just put a Dotcom behind its name, and they would like rise, even if they had nothing to do with Dotcom or with IT. For example, they would still keep that because it's representative of the good times that are going on. What is going on right now? IT is good, or for example, real estate is good. We saw this very recently in 2007-8. A lot of real estate companies started listing just because they had the real estate name and they did well, and then they burst, and obviously people have not made money. They have not even recovered what they have put in, first of all, because it was just this representative bias that was there. The one example that comes to my mind is during that time, there's a company, Reliance Energy. It changed its name to Reliance Infrastructure just because infrastructure was doing well. It had nothing to do with infrastructure. It was an energy company, So we need to be careful about all these small things, like what managements can do to play on our minds with these biases. And the last one is the endowment effect. Endowment effect is we think something is more valuable when it's in our possession, but we view it less valuable when it's someone else's possession. That's exactly when we want to sell something, we want to sell at the highest price. We want the best price, but we want to buy something, we always want a discount. Though the same thing can be there, but we have like different prices for different things, if we own it or if we want to buy it. So what happens during this time when the endowment effect is so strong is like brokers and analysts and even investors, if they are into a particular stock or into a particular sector, they start becoming salesmen for this. They'll go and tell everyone who's willing to hear that, boss, you buy this, this is damn good, nothing is wrong here, you have to get it. So this is something that we all are prone to. If we own something, we want everyone, you don't want that value to go down. We want it to be as good as ever. We want everyone to even have that thing and like you'll do anything to make that go higher and higher, that asset. So you become a salesman for the company or for the asset or for the sector. So these are the behavioral anomalies present and the human psychology, how we think during a bubble time. And the other things that characterize our bubbles are crazy valuations and high PEs. I mean, we've seen during the power boom, Reliance Power IPO came out. What was the PE? 900. 900 was the PE. I mean, people lapped it up as if it was going out of fashion. I mean, whatever happened to all those people, we know what happened to the stock after that. So we need to be very, very, very careful that we look at valuations during these times. I mean, we just can't tell, because a lot of people can give you any reason. Oh, this is a growth stock, this is a growth stock, this is a growth story. So the normal valuation parameters don't count here. There's like there can be something else, like for in the IT boom, how many eyeballs, how many people see your ad or how many people see that? That's just on eyeballs. So a bubble is characterized by crazy valuations and high PEs, and we need to be away from these triple-digit PEs and all because they never work. Speculative excesses, and that is exactly what a bubble is. It's just speculation, just a lot of speculation gone bad in the end. It's just speculation. There's no investment. People are just out there to make a quick buck and nothing else. Like I said, leverage and easy finance available. Like your brokers will give you margin trading, 10%, people will start margin trading at that point, and banks will be giving you companies loans, and very easy leverage and easy finance is available. Like I already pointed out, media's role to promote the euphoria. They are the ones who are responsible in creating these fads and fancies that people see. So media's role is actually quite a bit. Now let's talk about government's role. What do governments probably like? Even if they know it's a bubble there, they're not going to do anything because the sentiments are so good. They don't want to screw up the sentiments if it's a ruling government. They definitely don't want to like do anything which will make the sentiments of the people go down. It's in their best interest the sentiments remain up. And plus they go through this decision paralysis during a bubble, what to do, what not to do. So they don't do anything, and the bubble keeps going on and on and on until it's pricked. So they are just hoping that, you know, the bubble keeps going on until the next election is there, until they are in power, and that's what they are thinking about. So if you expect the government to do anything about bubble scenarios, then I don't think we should, because they're never going to do anything, because it's in their best interest that bubbles keep going on, because people are happy, sentiments are high, people are not complaining, everyone's happy, so why not, let it go on, no? And the best one is, if you ever hear, this time it's different, then you're surely in a bubble. Because we've heard that a lot, we'll hear it every time, and we hear it, and we'll keep hearing this. This time it's different, this time it's different. It's never different, and we'll see why. So, I want to say this, those who do not learn from history are condemned to repeat it, and that's what we have been doing. As humans, this is what exactly that's happening. We've not learned from any of our mistakes, and we continue to make the same mistakes, and probably we will continue even more to make the same mistakes, you know, because we don't understand this, and bubbles are formed in different forms, maybe in different assets, different sectors, stock market bubble or currency bubble, or it could be anything, you know, any bubble can happen, but it's the underlying scenario is the same, the same psychology, the same human psychology works in everything. The asset could be different, a sector could be different, but the psychology remains the same, a human psychology remains the same. So we will be continuing to, we continue to make the same mistakes. It's just that new players repeating the same old mistakes, you know. So now we'll look at history. We'll take a trip down memory lane, and we'll visit some of the most famous bubbles that we've that have taken place in our history. The first one this is the first bubble, right? It's in 1637. So it's been more than 350 years, but we continue to make the same mistake. So in 1637, the first bubble, the first bubble took place. It was called the Dutch Tulip Mania, and the only reason why this was there is because tulips supposedly look very exotic. That's the only reason that this bubble happened. Okay, so you can see the chart. Yeah, it's gone up like by 10, I don't know, 10, 20, from 20 to 200 in less than that many days. So, so tulips were introduced in Netherlands or in Holland, as you say, in 1593. What happens with tulips that they bloom for about 5 weeks, and they're transported for around 4 months. So that becomes the spot market. That's the only time when you can actually take delivery of tulips. In those 4 months, you can only take delivery of tulips. The rest of the year, there were futures. Even in 1637, they had futures. And the future is, futures are nothing but it's an intention of between two parties, the buyer and the seller, that they will give this quantity at this price at a decided date in the future. Okay, so we have the futures market and we have a 4-month spot market. This tulip grows in popularity. It becomes a luxury item, and people, for some reason, they just love it because they find that it's a rare, it's beautiful, and it's kind of a luxury item. So it becomes a fad. You know, like we said, like before we said that, you know, fads and fancies of the market, this actually became a fad. Speculation rises dramatically, and speculation just rose up dramatically because people were getting into future contracts not with no intention of taking delivery. It was just that, okay, some other fool, a greater fool theory, somebody else will come and take my contract and I will make that money. So there was the speculation was just amazingly high, and the price of one bulb, one flower, reached $100,000 for modern day price for one flower. So that was the insanity and then the insanity at height was that these bulbs were deemed too valuable to risk planting. So they would just keep it at home, or they just keep it lying. Nobody started planting them because you couldn't imagine that. So there's this one story that there was a visiting sailor who came, who visited Holland, and he obviously didn't know. There was no luckily that time there was not over information, or people didn't know what was happening in Holland. So he comes and somebody's house was there and a tulip was standing. He takes it, he thinks it's an onion bulb and he eats it. He eats the onion bulb and it's actually valued at $100,000, you know, at that point. This was at the peak. And obviously you could imagine what a fight broke out, but that was actually the kind of a starting of how this bubble got pricked, you know, because the bubble got pricked in 1637 when one or two buyers didn't show up to take delivery of these tulip bulbs, and that what led to extreme panic. They're like, oh, then people start thinking, then reality struck them. Okay, what if I've got into a contract and someone doesn't take my contract? What if it doesn't get honored? What happened? So massive panic selling happened. And selling happened, and there were only sellers. And we know what happens when there are only sellers. It's just one way down. It's just a one-way street down. Okay, so that was the first bubble in our history, which was only in Holland, thank God, and nowhere else. So we go to the next one. It's called in 1720, the South Sea bubble. It's called the Enron of England. Now, this is a very interesting chart. This is Sir Isaac Newton's chart of what happened to him during this bubble. So if you see, Newton invests a bit here, he makes money, exits happy. Newton's friends get rich. Envy. This is where envy comes. Envy and his greed. Newton re-enters with a lot. So this is when I was saying about greed and envy, this plays about. And so Isaac Newton, like, I mean, if he's a genius, if he's prone to such behavioral anomalies, we are just mere mortals. So we should actually take heart on that, you know. That Isaac Newton also made such a mistake. He enters here and he exits broke. So this is Sir Isaac Newton, believe it or not. So, you know, so we are all humans, we all think emotionally and we all think kind of alike. I mean, his IQ might be way higher than us, but he behaves the same way as we do. So no one is safe from these behavioral anomalies. So let's understand what happened with the South Sea bubble. 1711, Spain, a war with Spain leaves Britain in a $10 million euro debt. So the government decides to get into a deal with the South Sea Company, which is a financial institution, in which Britain's debt will be financed in return of a 6% return. The other thing that would happen was that this South Sea Company will get exclusive trading rights of the South Seas. South Seas is South America, today is South America, because Spain had colonies over in South America. So they allowed this company to have exclusive trading rights to South America. South America was very rich in gold and silver, whereas in England, what was there? Wool and fleece. The company comes with over-optimistic projections that, you know, that South Americans will be overjoyed to see our wool and fleece, and they will give all their gold and silver to us, you know. Over-optimistic projections. Okay, they had over-optimistic projections. Also, the added thing was that they will have monopoly for the slave trade. They'll be the only company who will be able to get slaves or take slaves there. They come out with the IPO. This company comes up with the IPO. It is lapped up, and how it was, wow, you know, it was like the next big thing. We all are going to get rich, everything, probably something like Reliance Power, no? Yeah. So this stock was issued, and it was lapped up quite a lot, even though everyone knew the management was totally inexperienced, and they were not very good management, you know. So when the issue came up and this company saw that, okay, you know, there's so much happening, you know, people are very excited about a stock, they come out with lavish offices to show that they are how awesome they are doing and how wealthy this company is. So they come up with lavish offices and all these things to excite the client, to excite the people there, the investors, and to make more investors come in. At the same time, management starts hyping up its stock. They are not concerned about what business they are doing, you know. They are not concerned about revenues, about operation. They see that these people, these investors are lapping up our stock and there's so much speculation going on. All they were there was to rig up the stock price. All they were into. That's why they call the Enron of India, because Enron of England, because they were just all into stock rigging. They started a rumor that they've got exclusive trading rights for the whole of all the Spanish colonies, for how much ever they can keep going, coming, keep going, coming. That was a big lie, because they only allowed 3 ships to go and come. So the management started these rumors, and they started manipulating the stock prices. What happens was that representative bias started working, because a lot of other companies saw that, okay, look, awesome, this IPO came out and everyone lapped it up, so even we'll come out with our own IPO. These companies are again bogus companies. One company was thinking of they'll have floating mansions. I don't even know what floating mansions mean, but you can guess what floating mansions is. You can. So companies were coming out with such crazy IPOs about floating companies and taking out energy from plants and all kinds of crazy stuff. And these were all lapped up. Okay. But obviously, when the bubble burst, you know what happened to these companies. They were probably worthless, So a lot of people burned their hand. 1718, there was a war with Spain again, okay, and no trade was possible to go from England to any of the Spanish, because they were in they were in a war. But still, people did not sell their stocks. They know no trade was happening. There was no business in this company. But why didn't they not? The endowment effect was so strong. They're like, we are holding it. This is so much more valuable. What does anyone else know? Over-optimism. That they were just overconfident about it. They had this strong endowment effect. Even imagine there's no business happening for this company, but their stock is still rising because people are still buying it, because the endowment effect was so strong. Then what happens in 1720 is that the company obviously knows that there was no revenues or operations in this. They weren't even remotely even concerned about like revenues or operations. But by 1720 they know that it was so bad that they sold all their stocks in the market. And like Sir Isaac Newton, there were millions of people who pretty much became bankrupt after this. And it took a while for after this, actually England even suspended IPOs and all these things, but obviously that came back later. But this was a very big bubble at that time, and during the 1720s. So here you see like the common themes that we've been talking about endowment effect, about overconfidence, about management taking advantage of the greed of the people. A lot of stuff. We see envy during where Sir Isaac Newton, his friends invested. Oh my God, I'm going to be left out. Let me also invest. So the same themes keep on repeating itself. Okay. So now we go on to the next bubble in our history, which is the Panic of 1837. As you can see, I mean, Granite Bank, Humblick Glory Bank, probably never heard of these banks, right? What happened? Let's see what happens. President Jackson shuts down the Bank of United States because it was found to be widespread corruption used to be there. He's like, let's shut these banks down. We just shut this bank because there's too much corruption. What happens after that is that the banking system gets heavily unregulated, and a lot of state banks and private banks start coming up. Like overnight, a lot of banks came up who were issuing their own money. Yeah. So they would give credit to anyone who could walk. They'll probably give credit to, from farmers to businessmen to layman people to industry, to anyone. They were giving cheap credit. And at the same time, the government decided that they are going to sell off a majority of public land to earn that money. So they want to sell off the public land, and all this public land that was sold was all only on borrowed money. Like because of this easy credit available to people. People would just get into this speculative land trading. So a lot of speculation was going on in land, because people believe that the rate of return that they will get from selling this land would offset the current debt that they are taking. But that was, again, this is exactly what people think. Oh, I will sell it off and somebody will be there to buy it, and I will finance my loan this way. This continuous. Like the land sales were in a period of 5 years becomes 10, 20 times what it used to be before. Currency depreciates obviously because of this, and inflation rises. Is just common, you know, because so much money is in circulation. So obviously inflation goes rise and currencies don't depreciate. Then President Jackson comes up with this new thing. It's an executive order passed. He passes an executive order named as the Specie Circular, which required all land purchase to be made strictly in gold and silver than banknotes which were being printed by private banks. So if you want now gold, if you want land, you have to give gold, and you take the land, okay? Because the money that was there was kind of worthless now. Disastrous effect, as you could guess, because the banks did not hold sufficient gold and the silver and any of these commodities, and the land sales and prices also started dropping at the same time. When they started dropping, banks started to call in their loans, and people did not have the money to pay the loan. So again, crash was massive crash after that, as you could expect. So this was the third big bubble in our history. The next one, which I think everyone knows about, is the Great Depression of 1929. This was actually one of the worst periods, I think, in American history. Let's see what happened during the Great Depression. We had the Roaring Twenties, time of great optimism, automobiles and some other electronic equipment and this and that. A lot of inventions were happening. The radios, automobiles, all this was coming. The consumer society was getting formed at that point. You know, okay, all these inventions are happening. We need money. We probably need to get into that. So everything was working very well. You know, and the whole of 20s, the extreme optimism, amazing optimism, you know. Again, the foundation was there, but the optimism was crazy because the stock markets became a place of great prosperity. Everyone wanted to get rich, and everyone was getting rich just being in the stock market, but by leveraging. This is when margin trading and all came into play, you know, where they would put a 10% down payment, and the rest of the 90% they would borrow and buy stocks, you know. So they've only paid 10%, but they've taken exposure to 100%. And everyone started buying, and everyone started getting rich nonetheless in the 1920s. But at this point, it should have been quite evident that there was so much over-optimism, overconfidence there, that this could have been ripe for a bubble, and it actually did, because in October 29, 1929, it's called the Black Tuesday, the day the stock markets crashed. This was, they say, the official beginning of the Great Depression. And there was a lot of signs before this date, you know, that there's something wrong. What used to happen was that before this also the stock market went down. The stock market went down, but people were like, and there was like banks and consortiums of these financial institutions who again started putting heavy money inside it. They're like, okay, we can't, because they had such heavy exposure, they had to do anything and everything to keep that up, you know, the market rising. But only that much you can do, because when they would do that, there would be a cheaters rally. A cheaters rally is when, what happens is when there's not actually a rally, you know, it's like, you know, the times are bad and times are going to get worse, but there are some people who are just going to pump in money for that artificial rise. So people, again, the sentiments don't change. The sentiment stays positive. Everyone stays over-optimistic and everything should be hunky-dory. But it never happens. We've seen that even in the financial crisis this time. I mean, I don't know how much of these bailouts and all is going to work, but we'll have to wait and watch how much that could happen. So at that point, the markets crash, panic spread. Banks were also again taking advantage of the greed of the people by investing people's money in stock markets, which they shouldn't have done, right? I mean, they had to be in something safe. All of people's savings were there. So a lot of banks started closing. A lot of people went to the banks, which was still open by that time. A lot of banks closed. So people overnight went to banks to get their money out. Few were lucky, but the people who weren't lucky got bankrupt overnight. When people took out money from the bank, again more banks shut. More banks shut means even businesses and industry were affected, because the stock market had fallen, number one. Banks had closed, people had no money. Unemployment became more and more. With this unemployment, people started curbing their spending, you know. They started like, they didn't want to buy any more automobiles or radios or whatever the Roaring 20s had in store for them. by the 30s, no one wanted to buy that. This again further shrunk the economy and the industry and the businesses, and which led to wide-scale unemployment. Unemployment was just phenomenal here. And with the same thing, there was something called the Dust Bowl. Farmers usually had been quite away from the markets and all that stuff. They were happy, they were farming, and they would get their own piece, and they would be happy. But at the same time, there was this Dust Bowl where there was dust storms and famines and farming activity also completely came to a stop. So as you see, like I think the whole of US was just inside this this Great Depression. Like nobody was saved. Somehow everyone was hampered by this, and it took Dow 25 years to erase those losses. So I mean, 25 years is a long time. If you bought something and it's not yet reached for 25 years, it's pretty much losing. A lot of people just lost everything. So this was a bad one. The next one was the 1997 Asian crisis. As you can see from the graph, it had to do something with currency. This is the Asian exchange rate against the US dollars. This happened in 1997. Let's see what happens. So we have something called the tiger economies like Philippines, Singapore, Thailand. Can't get the names. Indonesia, exactly, the tiger economies, which at that point had high growth, 10 to 15% per annum. Export economies, they became export economies from exporting basic goods to high-tech goods like semiconductors, automobiles. This is the time, the early 90s, where the Asian economy started exporting. And the thing about the Asian economy is that there was cheap labor, intelligent labor, like the labor intelligent, and there was hardly any barriers to entry for exporting goods and services. And no wonder they did phenomenally well. These exports led to a high investment boom in property, infrastructure, and industry. People and business started borrowing heavily from banks, which led to a real estate boom. Banks were very happy to lend as long as real estate prices were going up. This sounds familiar, right? I mean, this happened recently here also. So banks were just like, they didn't care. They're like, we will lend you money as long as real estate prices are going up. We don't mind. The thing was that all these loans the financial institution would be doing, they would be taking loans from US dollars, which was cheap, and giving it out to expensive loans in local currency. It was a straight arbitrage. It was kind of a no-brainer at that point. Borrow cheap, lend expensive, you make the cut, and wow, business is good. But they didn't think about the bad stuff that could happen. One was excess capacity, like because they were borrowing from banks, and everything was so widespread that buildings came up and all these factories and everything came up. But there was no need for so much capacity. There was no planning done. The ghost towns were there, like we spoke a few months back in China or somewhere else where the ghost towns were, quite a lot of ghost towns are there because they can't be sold. Excess capacity. Then we had the debt bomb because the currency started depreciating at the same time. They were pegged to the US dollar, and the currency started depreciating. Now if you've taken a loan in dollars, if the currency depreciates by 50%, your loan becomes more expensive by 50%. So first of all, when all this was happening, like excess capacity, anyway there was burden to pay off these debts. When currency started depreciating, it was like nobody could pay, and a lot of people defaulted, like the major financial institutions defaulted, and the currency and the stock markets kind of imploded by almost 70% in some places like Thailand, which was the first to be affected. And then when Thailand happened, then a host of other countries started. It was like a domino effect. So this had to do with the currency. This was a bubble in currency and stock markets. But again, we see the same overlying themes, like the greed and the over-optimism and the over-optimism of the future of these countries, and people started borrowing heavily and cheap credit available again. So the same overlying themes we see here. The next one was the dot-com bubble of 2000. So here, the dot-com bubble is basically a speculative bubble in shares of early internet companies called dot-coms. So what used to happen, what happened was early 90s, a lot of people started using the computer, businesses started using the computer, people had a computer at home, so everyone was becoming very computer savvy. Then like what we spoke before about the Asian economies being export economies with for computers and hardware, so the hardware was just becoming commoditized, you know. So now what? So the focus was then on software development. Software development was awesome in the sense that it was high profit margin, low cost to produce, because you just needed two college kids opening something in a garage and making a fortune out of it. So there was, and they would pay them, and they would pay their employees. The college kids would pay their employees in pizzas and coke, you know. So it was quite a low cost to produce. And the best part about it was patent protected. So once you got some patents, it's very hard for anyone to come there and you reap the benefits for a long time. So at this point, lots of small startups from straight out of college started coming up in Silicon Valley, and they saw the potential of these software development. You know, hardware was commoditized. You were getting cheap hardware from these Asian countries, and you were like, and the Americans were like, okay, you know, software sounds like a good plan, so let's do it, you know. So a lot of these small dot-com companies came up in Silicon Valley. This is a time when like venture capitalists started playing a bigger role. Venture capitalists would be financing startups, taking them public and reaping massive profits out of them. So any and every dot-com company probably had a backing of a venture capitalist, even though their business model wasn't great, but just they had .com written. So, you know, yeah, we can at least take them public, make some money and get out of it. That was what the venture capitalists were thinking. At this point, there was extremely irrational exuberance. Like, people were talking like, forget earnings, you know, we just think of how many eyeballs we capture, you know, how many people go to our software or see a program, and that's what it should be, eyeballs versus earnings. The other thing was there that BMWs were given as signing bonuses to companies which didn't really have any business, you know. They were still making, they probably didn't even have a business plan in place, but they were still giving out BMWs as signing bonuses. The idea of, at this point, there was this idea of a new economy versus the old economy, where the new economy was there, where inflation was virtually non-existent and recessions was considered as a relic of a past, you know. So that was there. Then when there was an IPO, they used to celebrate an IPO with millions of dollars. Millions of dollars were just spent on an IPO party just because the company was coming out with an IPO. Sure enough, people realized this in 2000, a little too late, but bubble pricked and reality came into play, and we see the Nasdaq actually falling from 5,000 to 800 in little more than a year. So here we see, you know, it's like common themes, like from 1637, from the Tulip bubble to more recently we had the financial crisis and our real estate bubble and infrastructure bubble and the power bubble and everything. So the underlying theme is the same, you know, that because of human behavior, our psychology, we don't learn from past mistakes and we keep repeating these same mistakes, you know. We've done it from 1637 onwards. It's been 350 years. We don't seem to have learned, and we're probably not going to learn. But the reason to share this presentation and talk about this is that at least maybe we can have a little clue, you know, by learning from other people's behavior. And when we see like this irrational exuberance in the market, or over-optimism, or like this envy, greed, when only people are talking about a certain asset class or something, at that point we must like step out and like look at it as thinking that it's probably a bubble, and maybe it's safe to be out, even though we cannot reach the top of the bubble. Maybe we get down a little lower, but it's better to stay away, because once the bubble pricks, prices drop substantially, and people have seen, like, since even from the IT boom, a lot of people have not even made that money. It's been 13 years and people could not make that money. So I think we need to put our greed aside a little bit and think of it as a bigger picture, and hopefully with this with these behavioral anomalies that I've spoken about, we could probably spot bubbles much earlier than other people and take advantage of that. And the other thing I want to say is that if you've noticed one thing is that from 1637 to now, globalization has played a big role. You know, today something happens in Cyprus which I didn't even know where to point out on the map before this whole fiasco. A small country like Cyprus can create havoc in this whole world. In 1637, okay, only there was tulip bubble only in Holland. No one else knew about it. But today with globalization, I don't think we are safe from any other country. If there's a bubble in some country, we still need to be protected with that. So at that, I'll leave it at that. Thank you.
How do you identify the beginning of the formation of the bubble?
That is very hard to identify, and that is probably you cannot identify it, because it always starts with some good news. A foundation is there, like I said in the IT boom, that information technology will change our lives, and sure enough it has changed our lives. But there's a nice platform to it. But when we see in the basic thing is, when you see in the media and the news channel that one thing is kept on repeating itself, you know, and people are talking about it, that's when we start realizing the platform might be there, and that's the time to, it's a very good time to get into that place at that point. But the point I'm making is that very bad. The point is that at the height of a bubble is very bad point to put your money in. So when you're like at that lower stage and the platform is there and there is good news there, it's fine. But when a lot of people are talking about it, and there's a lot of optimism and overconfidence in people that you see, it's only by human psychology that we can see that, okay, this is forming into a bubble, and that's the time to stay away from it.
And if you may share, having the past, Apas has dealt with some of these bubbles, you know, like Harshit Mehta's time, or if you can just share some of
Sorry, I can't
How
continue.
in the past,
Yeah.
Apas has dealt with your firm,
Yeah.
has dealt with some of these bubbles,
Yeah.
which recently happened in India,
Yeah.
like Harshit Mehta's times,
Yeah.
or any other time.
Yeah,
If you
so
can share.
yeah, so I can tell you about like the IT boom. The valuations were going crazy. You know, it was. I actually wasn't there at that time. These are just the stories I hear, so I'm just gonna say those. And
we can talk about Badla system, which was prevalent there. When this was a 300% type of Badla, what did our firm do to address that issue?
maybe you can, because I was actually a toddler then.
Maybe you can.
Maybe you can, yeah, come.
Okay, we had a Badla boom. I don't know, you must be knowing the Badla financing when the stock market when you had your stock markets which carried on perennially, because every 14 days you had a Badla. That means if you wanted to carry forward your positions, you could always do it. Now, this was, I'll tell you, summer of 1996, Rajiv? Or
Summer of 1997.
1997, where we were getting Badla. The interest rates was in the range of 48 to 60% interest.
300%.
Yeah, in certain cases, in certain splits it went up to 300%. But on average, you could get about 48 to 60%. So those were crazy times. That time, this thing, I was going to the
interest? Who gave the interest?
The Badla system was giving, the system. So that time I was going to the US, and I was a little bit perturbed because we had more than about 100 crores in our firm. We were doing Badlas for various clients, and that was a liability on my part, about 100 crores. I was not very sure what will happen over here. So I refunded all the 100 crores to our clients. I smelt a rat over there because something was too good to be true. See, today, where you excite your greed is when you are not, when you are not accepting that why should I be so lucky to get something like that. So in short, to answer your question for Neil would be, you can spot a bubble when you think something is too good to be true. after we refunded our Badla money, within 1.5 months, the Badla business crashed.
Wow.
Crashed. People went bankrupt. This was as near as 1997. They went bankrupt. A lot of clients then thanked me for giving the money back. A lot of clients came crying because when they had gone to me, they had fought with me. That what is this, Badla, you are refunding our money, you have to go to other broker. They went to other brokers and lost all the money. So that was one way we identified. Second was during the technology boom, where I started the study of behavioral finance, because in the technology boom I could not understand what was happening. So we stayed away from it. I would tell my clients to buy Hindustan Liver, Procter & Gamble, Gillette. They would come to me after other, what is this, 6 months it's not moved. My friend, this thing who had bought DSQ software, Pentaflow software, they all become multimillionaires.
DSQ, one fellow there.
DSQ, one.
Yeah, even I lost some people.
Yeah, so they all have become multimillionaires. So that was, in short, how do you spot a bubble? Don't be greedy, and you understand that if something is too good to be true, I would rather be away from
Yeah, but even also when the valuations go so haywire.
I'll tell you, Reliance Power, you would have invested in Reliance Power.
No, I didn't.
No, you did not. No, what I mean is not you, but a lot of people invested.
No, but Parag, why did nobody at that time come out and say that this is overvalued?
We did.
I lost all my business.
Not a single article in the papers.
Mine was in Times of India, and because of that, they saying we used to do business with Reliance Capital. They saying, Madhu Kela phones me up and tells me your business is stopped because boss did not like your article. And what I had told, Neil, it was not 900p, it was 5000p. Reliance Power was 5000p.
I was being conservative.
5,000. It was 5,000p, and all what he said, greater full theory was working over there. When I used to talk to my clients, it is very highly expensive. They said, no, I will sell it off, as it is. Because everyone was singing. And what happened? Everyone came to sell at the same time.
In fact, there was no E, so there is no question about PE.
Yeah, there was only price.
The difference between this bubble and black swan, are they correlated in any way?
No.
No, I don't think so.
Black swan will mean something else.
Something, yeah, some event or something which is.
The black swan will also happen when there is a bubble.
There could,
isn't it?
yeah, there could be, yeah, but yeah,
Do
probably.
you think gold is a bubble that just started, it's just tricked or?
Yeah, I actually spoke about this 2 months back actually, and the firm doesn't have a view on gold because we don't track gold and we don't have analysts to track gold. And first of all, and honestly, I don't think there's anyone who's called a gold analyst because no one could predict anything, any movement of that. But I do think it's kind of a bubble, and I think it's still overvalued, and maybe it'll probably come down. I mean, whatever this little, this kind of reminds me of one of the things here when I spoke about that cheaters rally during the Great Depression, where people were just, okay, it's come down a little bit, okay, now there's some value here, let's try to buy it and all that. So I think it probably spike up a little bit and probably go down, but that's just my personal view, and that's it. But I think we definitely saw a bubble-like scenario in gold. We saw last time we saw like the graph being extremely steep. Like I said, when it's extremely steep, when it's too good to be true, like he said, when it's too good to be true, when you're getting returns which are abnormal returns, then it's something to be scared of. Yeah. So I think it's
another thing about gold. What do you find so exciting in gold? It is not giving you any dividends. It's not giving you any interest. It's just a yellow metal which is going. So by nature, it is a speculative instrument. Why are people buying? I would say that you really require gold if you have physical gold and you are running away from this country. Then that gold will be valuable anywhere. So it's more of the derivative trading, that you have all this speculative activity. That's why Warren Buffett calls them weapons of mass destruction. It's because of this that people are buying gold. They are not buying physical gold. The demand which is there is on the derivative parts.
Which is the next item in India we're putting in the bubble? Real estate?
Yeah, real estate could be. Yeah, real estate, gold. Yeah.
No, gold is not widely traded.
It's quite widely traded now.
I mean,
Yeah.
but real estate.
Yeah, but real estate, there are some concerns about real estate, but we'll see how that pans out.
Middle class.
Yeah. So because there's like last time I said, there's again speculative trading in real estate, the margin trading in real estate, where you only paid 10% and the rest you think you'll sell it off to somebody else when the price goes up. Those are all again speculative activities which could lead to a bubble,
All these
definitely.
big advertisements you see every morning.
Exactly, that's again availability heuristics, when everything's available around you.
They hope to sell.
Exactly. When a lot of people are talking about the same thing, that's when we are fearful, because other people are greedy at that point.
Has somebody found out what are the number of unsold flats which all these big loaders and others are advertising?
Yeah.
It's there on all the real estate websites.
Sam, I'll tell you one thing. What you were telling over here before you came, with the property assessment taxes and all going up, and then you argued with me that I'm staying in a house, so there should not be any tax on it. At the same time, you feel very happy.
No, I said the tax on it will not will
affect the new, the second homeowners, not you. Now today, as a single, as an occupant, when you are having rates as high as 80,000, 90,000 per square feet, don't you think it's a bubble? Because a person just to stay over there requires what a fortune he requires.
Yeah.
That itself shows that it's a bubble. Secondly, the unsold flats which are there. Today you may have, someone may ask for an X amount of price, but then you have to have a corresponding buyer. Today even a working couple, both are working couple, if they take a flat on EMI, the way the rates are there, it's very difficult for them to survive.
What I'm talking is not is for middle class and lower. It's very expensive, high-rise flats near race courts and in suburbs.
Yes, so
Yeah.
Suddenly, you see.
correct, but that is so
hundreds, thousands of flats.
that itself
It should be a bubble.
shows
Yeah.
it's a bubble.
Then could be a bubble.
There's people who need the flat, cannot afford those flats, right? And only the high rises are getting built, and the people who actually require the flats are not getting. So these are probably second, third, fourth flats of some people who are like super rich. So
Leave aside that, you see what are the maintenance charges, how much you have to earn to just pay the society bills. Leave aside doing anything.
That came in the paper.
Yes. What does that show? Either you are becoming poorer. Because if you can't afford it, that means you are poorer. Or something is wrong over there.
But someone said that you can afford to buy because there might be a component which is called a black component. But for the maintenance, how can you? Maintenance you have to pay this because that is all.
If you have black money, then there are ways for doing everything.
So what I say is that maintenance charge cannot be paid in cash. That has to be paid to the society for paying the municipality and the other.
That is what our normal minds work. But why go? Those guys who have black money, their minds work differently. They are able to create those things. Anyway, any more questions? Neil, thank you very much.
thank you.
Just to tell you everyone, this thing on the 8th of
May.
We are going to this thing. I've been sending all of our FOF members an invitation from PPFAS. We are having a roadshow for our upcoming mutual fund. So we'll be sending you the invitation, but please mark your dates of 8th of May free. We're going to have dinner also over here. So please make it convenient to
What
you.
day it is?
8th is, what date it is? I mean, what day?
Wednesday.
Wednesday. Of course, PPFS will be sending you the invitations. Thank you. Mohan is not there, but the bar is open.